टंकसाली जी, आपकी तबीयत कैसी है?
या कुन्देन्दु तुषारहार धवला या शुभ्रवस्त्रावृता या वीणावरदण्डमण्डितकरा या श्वेतपद्मासना या ब्रह्माच्युतशङ्करप्रभृतिभिः देवैः सदा वन्दिता सा मां पातु सरस्वती भगवती निःशेषजाड्यापहा। शुक्लां ब्रह्मविचारसारपरमा आद्यां जगद्व्यापिनीं वीणापुस्तकधारिणीम् अभयदां जाड्यान्धकारापहाम्। हस्ते स्फाटिकमालिकां विदधतीं पद्मासने संस्थितां वन्दे तां परमेश्वरीं भगवतीं बुद्धिप्रदां शारदाम्।
Welcome, sir. Welcome to this session for analysis of monetary policy statement, April 22, which was announced 2 days back by the Governor of RBI, Mr. Shaktikant Das. Many things were being expected, but the Governor stuck to what he had said earlier, that we will be accommodative as long as it is required to, but at the same time, he sent a message also that time has come to give priority to inflation over growth. So he has set the tone for the next policy statement also at that time. So today we have, for analysis of the statement, Sundarajan sir, Dr. Apr22, Kalia sir, and Dr. Farid. First of all, Sundarajan sir will be setting the backdrop for this, the backdrop in which the monetary statement decisions were taken, monetary policy decisions were taken by the MPC committee. After that, Farid sir will be telling us whatever the decisions have been taken during the meeting. And then Kalia sir will be telling us about the sectoral impact of these decisions on various sectors of the industry. How does it impact? And then finally, Dubey sir will be explaining to us what has been the impact on banks on these decisions. So we will start, and I'll request Sundarajan sir to tell us about the backdrop, the economic and global economic situation, Indian and global economic situation in which these decisions have been taken. So over to Sundarajan sir.
Yeah,
Sir,
good morning.
please start your video.
Yeah, I will start the video.
So,
yeah, please enable the video sharing.
I'll give you the sharing also. First, you have to start your video.
I will start my video.
Yes.
No, host disabled participant sharing.
I'm giving it to you. I'm giving it to you, sir. Yes.
Good morning, Sundarajan sir.
Thank you. Good morning, panelists and my participants. It gives me immense pleasure to give the background of the economic setup, both globally as well as domestically. Let me begin with what the RBI governor stated. The sky today may be overcast with clouds, but we will use our energies, resolve, and resources to let the sunlight illuminate India's future. I mean, we should, because it's the toughest time that we are facing. So we should come out of this very, very successfully. Now, I am just now using his own terms so that the message gets conveyed properly. He used the term that the global economy has seen the tectonic shifts beginning 24th April when the Russia started invading Ukraine and the war started. Immediately the geopolitical tension started and it followed by sanctions. And again, this came at a very, very wrong time. Nobody thought that, no, this thing is going to happen. Absolutely, in economics, we call it as a totally external factor over which the domestic or the global economy has no control. Now, this came at a very, very wrong time. Already the global economy as well as the domestic economy was grappling with a sharp rise in inflation. And also some of the major advanced economies have started tailoring their monetary policy towards normalization. At the time, this has come. Now, UNTAD, this is also another important thing. United Nations Conference that has started stating that it downgraded the global economic growth projections. Originally, it said that no, the growth will be, global growth will be for the year, calendar year 2022, 3.6%. They reduced it to 2.6%, 100 basis points reduction. And UNTAD has also stated that Russia will experience a deep recession this year and there will be a significant slowdown in the growth expected in the Western Europe and Central, South, and Southeast Asia. All the places will have the slowdown in growth. And they also estimated that the US GDP growth will come down by 60 basis points from their original estimate of 3 to 2.40. China from 5.7 to 4.8. Russia, this is the greatest thing that they have forecasted, from 2.3 positive to negative 7.3%. That is what they said. And it has its own worries. There is a weakening global demand. There is an insufficient policy coordination at the international levels. And because of the pandemic, the economies were just coming out of the pandemic, though they have the elevated debt level. And this has created a financial shocks. And that is going to result in some of the developing countries into a downward spiral of insolvency, recession, and arrested development. I mean, this is what that UNTAD is forecasting what is going to happen. Now, if you take the global inflation, there may be some countries which will be comfortable. China, for example, inflation is 0.9%. Japan, 0.9%. Saudi Arabia, 1.6%. Switzerland, 2.4%. They are all very comfortable. Indonesia, 2.64%, comfortable. Australia, 3.5%, comfortable. South Korea, 4.1%. Singapore, 4.3%. France, 4.5%. Canada, 5.7%. South Africa, 5.7%. India, 6.07%. UK, 6.2%. Italy, 6.7%. Germany, 7.3%. Mexico, 7.45%. Euro, 7.5%. United States, 7.9%. Netherlands, 9.7%. Spain, 9.8%. Brazil, 11.3%. Russia, 16.7% at this time. And Argentina, 52.3% inflation. And backed up by Turkey, which is maximum in global economy today, with the inflation rate of 61.64. What is another important thing is Food and Agricultural Organization, FAO, has also come out and it started saying that the Eastern European region is known for the many commodities. Now, Ukraine and Russia, both which are involved in the war, they account for large component of wheat, around 14%, barley 19%, corn 4%. They add up to more than 1/3 of the global trade. Now, Russia is a major global producer of fertilizers, including nitrogen, phosphorus, potassium, which are very, very important. Dr. Farid will support me. That goes into the agriculture. Agriculture crops, they require the fertilizer. These are the basic things. Not only that, energy. Energy also, Russia plays an important role. And many of the European countries are dependent on Russia. And now energy prices are also going up. Once the energy prices goes up, it also affects the cost of the the products that are produced. And then wheat prices already have skyrocketed, 50% increase in the wheat prices. And then Ukraine is again a major producer of neon. And Russia is a major producer of nickel, and then platinum, silver, and palladium. About 45.6% of the world's consumption is being met by Russia. Now, these are all very essential in the manufacturing of chips, in the manufacturing of the semiconductor. So now, what worries, in addition to the UNTAD worries, FAO, the Food and Agricultural Organization, is also worried that the current conflict in Eastern Europe may result in food shortage, rising by 20%. 20% there is going to be a food shortage, and the prices are going to reach a new high. Already it reached in February end. Further, it is also going to result in, and there is going to be a cause for concern that there is going to be a food insecurity that might trigger further inflation at the consumer's hand level, and it may also affect the consumption of the consumers. That is also a thing that is escalated by Food and Agriculture Organization. Now, as we move further, now global economy, if you see what are the things, there are humongous challenges. Again, key commodities are all shortage. Already we have seen wheat, there is a problem. Wheat prices have gone. Edible oil prices are also at the elevated level. And there are also export restrictions at the producers level. And then the Black Sea region, they are not able to supply at all. There is a loss of supply. And then the feedstock cost pressures is going to continue due to the global supply shortages. And it is going to have an impact on the poultry, milk, and dairy product. And there is a fracture in international financial architecture. Currencies are moving in a different direction. Dollar is gaining strength. And much more important thing is there is a fear of deglobalization. Now, global economy, if you ask me, what are the important, there is extreme volatility in the commodity and financial markets. And then there is a global chain disruptions, adding to the input cost pressures. Conflicts in Europe as a potential to derail the global economy. And the two economy share is very, very huge, especially in commodities like oil, natural gas, wheat, corn, palladium, aluminum, nickel, edible oil, fertilizers, etc., as we have seen already. Now, crude oil prices. This is also another challenge. It has breached 130 per barrel US dollars, which is touching the thing record set in 2008, continued to be at elevated levels. And also, major advanced economies have started showing the risk aversion toward the emerging market economies, and there has been a capital outflow. With the result, there is a depreciating bias in the currency also. COVID-19 again has started showing its ugly face. in major economies in March 22. China, we are now hearing that there is a complete lockout, etc. And then again, it adds to the global supply bottlenecks and input cost pressures. And world trade and output, it will have an impact on world trade and output. And then the external demands are going to be weaker than what was envisaged about 2 months back. Now, globally, it shows the element of pessimism. Let us come to the domestic economy. Whatever the externally, globally that is happening due to the globalization, it is having its impact on Indian economy also. And already RBI is seized of things, and so they started making a downward. They have noted the downward risk in outlook, especially there is an upside risk to inflation and then downward risk towards the growth. Economic activity, though it is recovering, it is below the pandemic level, RBI has admitted. Again, in February 28, the second advance estimates released by the NSSO has projected the 2022 at a lower level. Private consumption and fixed investments are below the pre-pandemic levels. On supply side, contact internet services still trailed at 1920 level. Passenger vehicle sales registration continue to contract. War cloud has potentially impeded the economic recovery through elevated commodity prices and global spillover channels. Now, financial market has experienced a volatility, and then there are monetary policy normalization adopted in certain advanced countries, which have got an impact on India. Further, there is a COVID-19 infections in major countries, which resulted in the supply bottlenecks, shortage of critical inputs, etc. Inflation, the spike in inflation, crude oil price is again creating a inflation through the direct and indirect effects. And friends, I want you to notice, yes, when the RBI governor at the end of the monetary policy, he made a statement. What is that you have estimated in your calculation? He said, crude oil prices, we estimated the price of $100 per barrel. That is what he has estimated. It is also a fact to note that the Goldman Sachs has estimated, they made a forecast that the crude oil prices will be at the level of $120 per barrel during the Q2 of 2022. It will be at 135 per barrel for the second half of 2022. It may come down to 110 per barrel in 2023. See, this is what the things that our calculations, RBI governor has gone on record to say that, he has taken into account in his calculation, inflation estimates, etc., that the crude oil price will be at $100 per barrel. That is also a fact to be remembered. Now, because of the act of the advanced economies trying to go to the normal route, they're tailoring the monetary policy toward the normalization. It has shown its impact on the Indian economy. Now, if you see the FDI flows, the FDI flows have started moving out. It started moving out. It is also a fact to bear in mind that Goldman Sachs has estimated that FDI flows to India will remain tepid in 2022 calendar year. They estimate that it will be only to the tune of $5 billion as against their earlier forecast of $30 billion. And from equity market, we are all aware, already $15 million have moved out. And then US economic team has gone on record to say that about 200 basis point hike rate hike is going to be affected by Fed in 2022. So this is also going to have an impact on India. So these are all going to have an impact on Indian macros. What it is going to result in that the balance of payment position as far as the current year 2022, that is calendar year 22, Goldman Sachs has estimated that it is going to have an impact of negative to the extent of $50 billion, as again surplus of $55 billion in 21, surplus of $100 billion in 20. So the commodity prices remain elevated because of the sanctions and other things. That way it is happening. So inflation is one thing which we may have to have a relook, and RBI governor said that no, we will take actions. Whatever the action that are deemed to be done, we will do it. Because you may remember in the press conference, one of the reporter asked the question, already in the first quarter, we have breached the limit of 6. The second quarter, also, your estimate is 5.7. So you may breach it to 6. And then are you going to incur the 3 quarters? The inflation is going to exceed that 6%, which is the ceiling that has been given in the agreement entered with the government. RBI governor said that no, we will take actions, whatever that is required. That way is doing it. We wish that the inflation should be contained at the earliest. Further, domestic pump prices, there is a sharp increase in the prices, and it is feared that it may create a second round of price pressures. So the combination of the high international commodity prices, elevated logic disruptions could aggravate input costs, not only in agriculture, manufacturing, but also in agriculture, manufacturing and services sector. And then their pass-through to retail warrant a continuous monitoring and proactive supply management, which RBI has recognized. Financial markets are likely to remain volatile on rising risk premia, dislocation in trade, capital outflows, and divergent monetary policies responses across the central bank. Now, having said negative, what are the silver lining in the Indian economy? That is also an important thing, which RBI governor has also brought it, which we have to give importance. The first thing is we have created a strong buffers over the years, including the foreign exchange reserves. But again, there was a disturbing item that today's newspaper, it carried that no foreign exchange thing is also, it has, there is an outflow of nearly 14 billion. It has moved during the recent past. That way, it has also, today's newspaper item has carried an item. FX reserves experiences a steep fall of about 12 billion, and it is at a level of 606.425 billion, dipping for the 4th straight weeks. In the 4 weeks, India have lost 27 billions of the foreign exchange reserves. Okay. And then significant improvement in the external sectors. Well, exports are doing very well. And also imports are also increasing. When there is an import in increases, it means that activities are picking up, etc. And then there is several high frequency indicators like railway freight, GST collection, toll collection, electricity demand, fuel consumption, import of capital goods have posted a robust year-on-year growth. With the easing on the restriction, domestic air traffic has also rebounded in March. Much more than that, RBI also continuously conduct the surveys, the consumer confidence index survey, business confidence index surveys are all indicating that there is an improvement, and households have optimism, and then the business is also in the optimistic territory. Both the manufacturing and services PMIs are in the zones of expansion. Though the manufacturing is slightly moderated, composite as well as services have improved. Rabi output should support recovery in the rural demand. Similarly, pickup in contact intensive services should help in further strengthening the urban demand. And then invest activity may gain traction with improving the business confidence, pickup in bank credit, continuing support from the government capex, and congenial financial conditions. That way, India's merchant exports, as we all aware that in 21-22, it overshot the target of 400 billion. And there has been a sharp escalation in the international commodity prices in conjunction with that domestic demand as also thing, and imports bill has also gone up, and there has been a widening of trade and current account deficit. That is what is happening. So, but the one silver lining here is the sustained and robust growth in the services exports and also inbound remittances continue to keep our invisible account balance in large surplus, which has helped us to meet a part of this current account deficit, etc., etc. Now, capacity utilization in the manufacturing sectors are also recovered. It has moved to 72 plus from 68.3%, etc. India's direct exposure to the countries at the epicenter of the conflict is not there. Rabi harvest would help to keep the domestic prices of pulses and cereals under control. Again, India's merchandise export, which I already talked. And then the governor has also ended his monetary policy presentation with the quote from the father of the nation, Mahatma Gandhi. It is the faith that steers us through the stormy seas, faith that moves mountains, and faith that jumps across the ocean. Let us all have a faith saying that our economy will come out of the problems and will navigate successfully through the troubled waters. And thank you, Mr. Arvind. Now over to Dr. Farid. Thank you so much.
Is it visible? Slide.
Yes, please.
It's
Yes,
visible,
please.
sir. It's
Okay.
visible, please.
So very good morning to all of you. At the outset, I take this opportunity to congratulate all the promotees on behalf of our Allied Bankers Club and also my behalf, Mr. Tarsem Singh Zira and Rajendra Mohan from PNB and Mrs. Janani, Mr. Santosh Sahu and Ms. Makhija from Union Bank of India. I think all of them are here. So very hearty congratulations to all of you on your deserved promotion. And also I wish all the best to the participants from Punjab and Sindh Bank who are participating in the promotion process, in ensuring promotion process. All the best from our club.
So Mr. Barjati also has been promoted. He is also a member of our club.
Okay. Hearty congratulations to him also. So friends, just now we heard Soundarajan ji. As usual, he has given a very detailed description of the economic and political situation internationally and also its impact on the Indian conditions. As you are aware, this is the first monetary policy statement for the financial year 22-23, coming particularly in the backdrop of, in fact, the easing of the pandemic situation, but a flaring up of geopolitical tensions in the world. So under those circumstances, the Reserve Bank of India or a MPC committee has come out with this monetary policy, keeping the overall situation, the worldwide, the GDP growth was projected. In fact, as Soundarajanji was telling, the escalating geopolitical tensions, it is expected that they are going to cast a shadow on the economic outlook of our country. Keeping in view the elevated commodity prices, tightening of the global financial conditions, uncertainties owing to the policy normalizations in the advanced economies, and continued supply side disruptions and weakening global demand, it is going to have a negative impact on the gross domestic product growth of our country. So prior to the announcement of this policy on 8th April, it was projected in February 7.8% GDP growth for the financial year 22-23, but it has been downward reduced to 7.2% for the year as a whole. But the first quarter, it was reduced from 17.2% to 16.2%. If you see all the quarters, it has been a downward revision has been done, 7 to 6.2, 4.3 to 4.1, and 4.5 to 4.4%. Coming to the next, another aspect is the inflation. As we just now discussed how the inflation in the country will be affected because of the global situation. As usual, the spike in the crude oil since February end is posing a substantial risk on the inflation of the country. International crude oil prices remain volatile and elevated. See, they're not only they are increased, but they are very much volatile, and this will have an impact on our inflation. Then cost, price, and supply chain disruptions. And as we discussed, the very evolving geopolitical volatile situation and its impact on the global commodity prices and the logistics will have impact on the inflation. See, because the inflation concerns have aggravated as oil prices rose, and also already Soundarajanji has told it is passed through the retail sector, and its a secondary impact will be definitely seen in the coming quarters. That's why the inflation has been upward revised from 4.5, which was assumed in the last February, to 5.7 for the financial year as a whole. And in the first quarter it was revised from 4.9 to 6.3 upwardly. It is the beyond the inflation target given by Government of India, that is 6%, 4 plus 2%. And assuming that the inflation will come down in the next quarters, it has been predicting that it is 5.7 for the year as a whole. But if you see, even in the third quarter, it is a upward revision by 1.4% as in the first quarter. So not only this, as Soundarajan was telling that it will have impact on the manufacturing of the fertilizers because we import the fertilizers. It will have impact on the agricultural activity and cost of cultivation. Automatically, the food inflation is expected to be pressurized over the coming months due to elevated prices of particularly edible oils, because India depends on the major portion of edible oils by imports. So it is going to affect the food prices substantially. So assuming a normal monsoon during the 2022 and the average crude oil price, that is the Indian basket, though it is prevailing is more than 110, 20, 30, whatever may be, the average Indian basket, it may be presumed that it will be $100 per the barrel. The inflation is now projected at 5.7% for the year financial year 2023. So friends, spike in crude oil prices and geopolitical situation, the likelihood of supply chain disruptions and dislocations in the trade and capital flows, divergent monetary policy responses, and volatility in the global financial markets are imparting sizable upside risk to the inflation trajectory and downward risk to the domestic growth. That's why this policy has given the inflation projections at higher side, and growth at a lower side as compared to the February monetary policy. Coming to the policy rates, the MPC voted unanimously to leave the repo rate unchanged at 4%. It is the 11th time in a row since the last time the repo cut was made on 22nd May 2020. There was no change. Consequently, the reverse repo rate was unchanged at 3.35 and bank rate and marginal standing facility remained unchanged at 4.25%. So all the four policy rates and also reserve ratios, CRR and SLR, were kept at 4 and 18% of the net demand and time liabilities respectively. So there is no change at all. Then stance, accommodative stance. This time, the difference between the earlier few policy announcements and now is the panel decided to continue the accommodative stance in the background of elevated level of inflation and heightening of the geopolitical situations unanimously. Every time this either 5:1 voting has to happen, but this time unanimously they have done it, retaining the repo rate at 4% and reverse repo rate at 3.5%, continuing with the accommodative stance. We almost all everybody expected these things, and but it has given a signal towards the tightening the ultra liquidity, which we will see a little later. Now coming to the liquidity management measures announced. The central bank would continue to manage the liquidity in a manner to maintain the financial stability. What the central bank's policy indicates that it will manage the liquidity in a manner to maintain the financial stability. There is a huge chunk of 8.5 crores excess liquidity is there in the system. So the RBI will engage in a gradual, calibrated, multi-year withdrawal of that liquidity in a non-disruptive manner beginning from this year. So over a period of time, not only the entire liquidity will be sucked out within a year, but it is a multi-year withdrawal in a gradual and calibrated way. Then what they have announced, the introduction of a standing deposit facility. It is an additional tool for absorbing the liquidity at an interest rate of 3.7%, which will form the floor of the liquidity adjustment facility corridor. This standing deposit facility is being introduced to provide a symmetry to operating framework of monetary policy. What is this standing deposit facility at all? So far, Reserve Bank of India have been using 3 policy rates, that is in the LFA corridor, that is your repo rate, reverse repo rate, and marginal standing facility. Repo rate, you are all aware, at which it lends to the banks, and reverse repo rate, at which it drains the excess liquidity in the banking industry from the banks, and the marginal standing facility is the rate at which RBI supplies liquidity to the banks. So these are the 3 policy rates being used by the Reserve Bank of India till now. Now, when the banks have excess funds, as you are aware, they will lend to Reserve Bank of India and at the reverse repo rate, which is lower than the repo rate. As of now, repo rate is 4% and reverse repo rate is 3.35%. But this facility is against the government securities as a collateral security. Government has to give government security as a collateral to suck the liquidity under reverse repo rate operations. But standing deposit facility does not require any collateral for liquidity absorption. This is the advantage for the Reserve Bank of India. They need not create any government securities to absorb this excess liquidity. In fact, this concept was recommended by Urjit Patel Committee in 2014. But it required some amendment in the Reserve Bank of India Act, which was done in the 2018. And for the past 3-4 years, the Reserve Bank of India was thinking of a standing deposit facility. And even in earlier monetary committee statements, the governor has said that at appropriate time, the standing deposit facility will be introduced in India. So accordingly, it was introduced in this policy. So the main important advantage of introduction of SDF is by removing the binding collateral constraint on the Reserve Bank of India. This SDF will strengthen the operating framework of monetary policy. So in fact, this again, it was stated in the policy that the standing deposit facility will replace the fixed reverse repo rate. In fact, this fixed reverse repo rate is the floor for the liquidity adjustment facility corridor. But it was also mentioned that even though it is replacing as a floor, it will be in the kit of Reserve Bank of India as a monetary policy to rate, and it will be used appropriately in the future. So in fact, actually, this earlier, the repo rate and reverse repo rate were available, and MSF were available to the banks. Now, both the standing facilities, that is a standing deposit facility and marginal standing facility, both will be available to the banks on all the days of the week, and access to standing deposit facility or marginal standing facility will be at the discretion of the banks. So the RBI's plan by introducing this is to restore the size of liquidity surplus in the system to the level consistent with the prevailing stance of the monetary policy. So the SDF facility or the tool will help the Reserve Bank of India to absorb the excess liquidity. As you have seen that the interest rate is kept at 3.75%, it is a 0.25% less than the repo rate applicable. So this will be applicable to overnight deposits at this juncture. However, to retain the flexibility to absorb the liquidity of long-term nature, whenever their need arises, the Reserve Bank of India will absorb the liquidity with appropriate pricing. So this is the new concept, new tool or a new mode of absorbing the liquidity was introduced in this policy. This is the most important one. Then restoration of the symmetric LAF corridor. RBI has decided to restore the liquidity adjustment facility corridor to 50 basis points. First of all, what is this corridor in the monetary policy language? The corridor in a monetary policy of Reserve Bank of India is the difference between the reverse repo rate and the marginal standing facility. As we discussed, the reverse repo rate will be the lowest rates of the policy rates at which Reserve Banks observes the liquidity from the banks, and marginal standing facility is something like an upper ceiling at which the Reserve Bank will lend to the banks against the government SLR securities. So the difference between the SLR security and the reverse repo rate is called the liquidity adjustment facility corridor. So if you see as on date, the reverse repo rate is 3.35% and marginal standing facility is 4.25%. The difference is about 90 basis points. So the Reserve Bank of India has decided to restore this corridor to 50 basis points by introducing the standing deposit facility. The difference between the standing deposit facility and marginal standing facility is 4.25 minus 3.75. It is a 0.50 basis points. The expectation is this restoration of symmetric LAF corridor will bring symmetry to the operating framework of monetary policy by introducing this SDF. Thus, even at a lower stand, there is a 3.75 SDF to deposit, to draw 4.25 at marginal standing facility. Both these facilities, as we discussed, they are available to the banks and the access is discretionary to the banks. Then this restoration of symmetric LF, why they used this? In the year 2020, during the pandemic, prior to the pandemic, it was the difference was only 50 basis points, but during the pandemic, the reverse repo rate was reduced as compared to the repo rate by 65 basis points, which was only 25 basis points. So earlier monetary policy statements. So that 65 difference between the reverse repo rate and repo rate plus 25 basis points more in marginal standing facility as compared to repo rate, totally 90 basis points it was increased. So now the Reserve Bank of India is thinking to restore fully the pre-pandemic liquidity management framework as prior to February 2020 in view of gradual return of normalcy in the financial markets, which were adversely affected by pandemic. So the introduction of this SDF, which is having the two objectives. One is sucking, not only sucking also at a higher rate as compared to the reverse repo rate. Now that's why in this now liquidity adjustment corridor, the lowest rate will be SDF rate, that is 3.75, and highest rate, the other side of the line is 4.25 under the marginal standing facility. Why this has to be done? Because as you are aware, in the last year, the Reserve Bank of India has introduced the variable reverse repo ratio, and the reverse repo ratios were announced at a different time, and the quantum of sucking or the absorption of the liquidity was announced prior to the in advance, and it was absorbed at a rate which is more than the ordinary reverse repo rate. So almost all the rate has gone up to the 3.9 to 3.95, which was nearer to the repo rate, and the Reserve Bank could be able to absorb 80% of the liquidity from the market by using the VRRR. Now the Reserve Bank is introducing the standing deposit facility to absorb the remaining liquidity, or the liquidity which is going to be expected to be in the coming years, in the coming days, at a 3.75%. Then as far as the regulation and supervision statements announcement are concerned, the individual housing loans rationalization of the risk weights. You are all aware that after the pandemic, the Reserve Bank of India in October 20 has come out with the announcement that earlier there were two criteria for the risk weights on the housing loans. One is the quantum of the loan. The second one is loan to value ratios. So due to the pandemic, they have removed the quantum of loan, and they have kept only loan to value ratio for the risk weights. Recognizing the importance of the housing sector, its multiplying effects, and its role in supporting the economic and credit growth of the banking industry, now it has been decided that this rationalization of the risk weights, which is based on the loan to value ratio, is going to be continued in respect of all new housing loans, which will be sanctioned up to 31st March 2023. Then another regulatory or supervisory announcement is enhancement of the limit of SLR holdings in HTM category. In fact, RBI had increased the limits under the HTM category from 19.5% to 22% of net demand and time liabilities in respect of SLR eligible securities acquired on or after September 1st, 2020 up to March 31, 22. This dispensation of enhancement in HTM limit was made available already up to March 23 under the March 23. However, now with a view to enable the banks to have a better management of their investment portfolio, it is now being extended. It is increased to 23%. So from 22 to another 1% increase in the HTM, and these HTM limits will be restored from 23% to original 19.5% in a phased manner, starting from the quarter ending June 23. The another one is that the governor, the Reserve Bank of India, is going to have a discussion paper on climate risk and sustainable finance. Climate change. It is because the climate change may result in a physical and a transitional risks that could have implications for the safety and soundness of individual regulated entities of the Reserve Bank of India and as well as financial stability. So it may have the implications of the safety and soundness of regulated entities and in general the financial stability as a whole. The Reserve Bank of India decided to have a discussion paper on climate risk and sustainable finance. And also another one is, it is decided to set up a panel to review the customer service standards in RBA regulated entities. It's again, you are aware, the financial landscape has changed tremendously. It is undergoing a revolutionary transformation consequent to the technology development, rising of the customer base of the banks, and the age or the demographic nature of the customers, advantage of the digital products, service providers, new service providers, fintechs or payment banks, all these things, as also the rising volume of the digital transactions, keeping all these things. So Reserve Bank of India thought that there should be a panel to review the customer service standards in all the RBA regulated entities. Then coming to the payment and settlement system announcements. Interoperable cardless cash withdrawal at ATMs. Because cardless cash withdrawal through ATMs is already a permitted mode of transactions, but it is being offered by few banks in the country on basis. Means it is only for their customers. The other customers cannot operate cardless cash withdrawal at the ATMs of other banks. So there was it was felt that there is a need for the cardless cash withdrawal at all the ATMs, because the absence of the need for a card to initiate a cash withdrawal would help in containing the frauds, like skimming, card cloning, device tampering. All these things can be avoided by using the cardless cash withdrawal. So to encourage the cardless cash withdrawal facility among all the banks and among all the ATM networks and the operators, it is proposed to extend the cardless cash withdrawal facility to all the banks and ATM networks using the UPI. Another thing is Bharat Bill Payment System. Rationalization of net worth requirement for other operating units. Actually, the Bharat Payments transactions has increased substantially. Actually, Bharat Bill Payment System has increased in the volume of transactions, and the number of onboard billers is substantial. But it is observed that this is mainly happening in the bank-based Bharat Bill Payment operators. Non-bank Bharat Bill Payment operating units showing the very less growth. The main constraint, it was felt that their minimum requirement of the net worth for non-bank Bharat Bill Payment operating units was 100 crores. So this was felt as the major obstacle for them to participate. So the Reserve Bank of India has decided to reduce this net worth requirement from 100 crores to 25 crores. Then the last announcement which they have made is the cyber resilience and payment security controls of payment system operators. They want to issue the norms on the cyber security for payment system companies. See, payment system is playing a very, very important and catalytic role in promoting the financial stability, financial inclusion, and also increased reach to the nook and corner of the country. With the greater adoption of digital payments modes, it is felt that very important that payment system infrastructures has to be monitored, or they have to be safeguarded from the cyber frauds, because the payment infrastructures are not only efficient and effective, but also resilient to conventional and emerging risks, specifically those relating to cybersecurity. So, keeping this, the Reserve Bank of India, as far as the banks are concerned, the Reserve Bank of India has already prescribed security controls for digital payments and services for the banks and the credit card issuing NBFCs. Now it is proposed to issue similar directions for payment system operating companies also. So these are the important announcement has been made by the Reserve Bank of India pertaining to in the monetary policy. And overall summing up, we will do after all the four members, or my senior colleagues will do it. So thank you very much. Over to Kaliaji.
Good afternoon to everyone. First of all, let me also join Dr. Fareed in conveying my heartiest congratulations to all the members of the Elite Bankers Club who have been successful in recently concluded promotion exercises in their respective banks. Well, friends, Dr. Sundarajan has very elaborately shared with you the entire global and domestic backdrop under which this particular monetary policy decisions were taken by the MPC in the meeting that was held from 6th to 8th April. I think he has very, very elaborately shared with you the outlook for GDP, global GDP growth, global inflation levels, the kind of impact the entire world economy is going to face ever since Russia invasion of Ukraine on 24th February 2022. Well, friends, world has become an absolute different place since Russia's invasion of Ukraine on 24th February, and I mean the kind of impact it has on the global economy. I think that was very, very elaborately shared by Dr. Sundarajan with all of us. And it is very important in the context of what I am going to speak to keep that in mind as to whatever he has shared with you. Also, Dr. Fareed has shared with you all the major policy announcements that have been made in the recently announced monetary policy and all the 7 regulatory and development measures that were announced by RBI as a part of the monetary policy in this particular policy. Now, friends, let's first of all, if I have to talk about the impact of this monetary policy on various sectors of the economy, it is very important for us to recapitulate as to what was that was different in the policy, in this particular policy, as compared to the previous policy. Because we cannot really appreciate the impact on the various sectors of the economy unless and until we recapitulate as to what was different in this particular policy. My own reading is that, all rates have remained unchanged. Of course, there has been one very significant new introduction, that is of standing deposit facility, that has been very elaborately discussed with all of you by Dr. Farid. Now, this is one significant change, and another aspect of the significant change was that a LFA corridor, which was earlier 90 basis points, is now reduced to 50 basis points. It's a very significant change. Though repo rate and marginal standing facility and reverse repo rate have been kept at the same levels, there is absolutely no change. But this is a very significant announcement, and we will discuss as to how it is considered significant, this introduction of standing deposit facility and reducing the LFA corridor to 50 basis point, which was the case prior to the kind of measure that were announced by Reserve Bank of India during the pandemic period. This is one particular thing that we have to keep in mind. Second is, Dr. Free shared with you that the stance, which is very important for the markets, that continues to be accommodative. They have still used the word accommodative stance, and it has been decided to maintain accommodative stance. But you have to read what is added to that. And I will tell you what is the difference between what was stated earlier and what is stated now. They have added, it has been decided to retain accommodative while focusing on withdrawal of accommodation to ensure that the inflation remains within the target, that is 6%. You remember, that is 4 plus minus 2 and minus or plus 2%. That is 6% is the inflation target that has been agreed to by RBI with the Government of India to ensure that inflation remains within the target. And while they have also said comma, while supporting growth. Now, this is how they have described this time accommodative stance. Now compare it with what was decided, what was stated in the previous policy, which was announced in February. It was then also decided to retain accommodative stance and retain accommodative stance as long as necessary in order to ensure a sustained and durable recovery and with a view to mitigate the impacts of the COVID-19. Very important words was as long as necessary in order to ensure what? Sustained and durable recovery. Now you can see the two descriptions of the accommodative stance and clearly make out what is that has changed. First time since last so many monetary policy pronouncements, there is an acknowledgement on the part of the RBI that inflation is a concern. And why is it so? Because January CPI inflation print came at 6%. And February CPI inflation print came at 6.07, or you can say 6.1%, which is the targeted level of inflation. And if you will go through the projection that have been given by RBI for Q1, you know how much change they have made for the next financial year, 22-23. It is from 4.5%, which was the earlier target of inflation, it has been increased to 5.7% for the whole year. 120 basis points more. And for the first quarter, they are saying it is going to be 6.3%. Now, this is also something that has to be remembered by us in order to analyze the impact. That yes, RBI has acknowledged that inflation is a concern and they will have to deal with it. And what they have, while retaining the accommodative stance, already done is they have given a signal by introduction of this standing deposit facility of normalization of the policy rates or indirect increase in the reverse repo rate from 3.35% to 3.75%. Earlier, you know, as Dr. Freed was explaining, under reverse repo rate, when they suck out the liquidity, whatever comes, they have to provide collaterals. Now, under this particular arrangement, no collaterals are required to be provided by RBI to the banks which are depositing their surplus money with the Reserve Bank of India, and the rate has been increased to 3.75 from 3.35. But RBI did mention that fixed reverse repo rate of 3.35% will be continuing to be a part of their toolkit, right? And would be used as and when required. Correct. So this is a very significant two announcement that you can pick up. One is, what is the target of inflation that they have set? Second is, what is that they are talking about accommodative stance as compared to the previous? And third is this introduction of marginal standing deposit facility. Now, you also see there is another dimension that has taken place. That is that GDP growth target has been reduced by 60 basis points from 7.8% to 7.2%, as was explained by Dr. Farid. So on one hand, we have a scenario where there is a downward, reduction in the GDP estimates and an upward, projections of CPI inflation. Now, this is the background under which we have to understand the impact that is going to take place. What is that I get? See, it is not mentioned anywhere in the monetary policy. Whatever has been shared by our respected Sundarajan sir and Dr. Farid is a part of whatever you read in the document. But you have to now discern what is the message that is being conveyed. Message that is being conveyed is that, yes, probably from the next policy itself, there is going to be that kind of approach which will change the accommodative stance to at least neutral stance. That is one thing which is generally being talked about. So it no longer will be accommodative, it will become a neutral stance. Second thing that is being talked about is that maybe in the August statement, there has to be an upward increase in the interest rates. That means repo rates may go up. Now, to what extent this will go up, what would happen? That is something that we will have to wait and watch as the entire global environment undergoes a change. Now, these projections have been made with one assumption, which I think either Dr. Sundarajan or Dr. Farid mentioned. What was that? That was that they are assuming that the crude oil prices will be at US $100, which you will all recall has touched even US dollar 136 after this war broke out. Now, and that is also, he was talking about Goldman Sachs reports. Their own statement also in the policy states, if you go through the Monty policy report, that there is going to be impact on the CPI inflation and growth projections if this assumption doesn't hold good. That means if it goes from say $100 to $110, if they have to change, then probably the inflation will go up by another 20 basis point, that is 5.9%. And there would be a reduction in GDP growth by 40 basis points. That is the kind of impact that it is going to have. Now, under this background, one thing is very clear, that there is an adequate signal of interest rates going upwards. Under that circumstances, the impact is going to be felt on those sectors of the economy which are sensitive to interest rates. Which are those sectors? First sector is our own sector, that is financial sector, banking sector. What happens in normal circumstances? What happens in normal circumstances is when the interest rates go up, is it positive for the banks? Yes, because whenever there is a repo rate rise, interest rates on lending portfolio of the banks go up, while the interest rate on liabilities get repriced only at the repricing of the term deposits. All right. So there is a lag effect so far as repricing of liability is concerned, but there is an immediate impact so far as repricing of loans is concerned. So it is believed that in the rising interest rate scenario, it is a positive for the banks. This is one sector that would be positive, but it is felt because there is a heightened economic activity because of which the inflation goes up. Is it because of that inflation is going up? That is something probably most of us won't agree, because it is because of the external environment that it is happening, not because of heightened economic activity. Otherwise, RBI would not have to bring down its projections of GDP growth. Correct? So that heightened economic activity, which is normally associated with a rising inflation environment and rising interest rate environment, that is just not there because of the projection that have been made. So whether it would be having the normal impact on the banking sector, that's a big question mark given the kind of environment that is prevalent currently. Okay. Now we come to the other. Similar is the case for NBFC sectors, broking companies, all that is comprising of financial service sector. Correct. Now, second sector which gets impacted is real estate. This is one real sector which is very, very adversely impacted with the interest rate rising scenario, particularly commercial real estate. That is, I think that needs no elaboration, because commercial real estate sector definitely has, much adverse impact because of the cost of the borrowings when the interest rates go up. This is a very interest rate sensitive sector. So that is something which I would consider may not be all that positive for commercial real estate. But there is another very important sector, that is housing sector, which is given a lot of importance by the government, by all, economists and everybody. And what is the impact on housing sector? Housing sector is also susceptible for its growth so far as interest rate environment is concerned. But you would have seen from one of the regulatory measures that have been announced by Reserve Bank of India that RBI has already anticipated the kind of impact that rising interest rate environment may have on housing sector, and have come out with that regulatory dispensation, which Dr. Freed was sharing with you, that is about risk weights. Low risk weight, which was introduced not on the basis of quantum of loans, but only on the basis of loan to value since October 2020. When you remember, there were only two criteria: LTV 80% and below, 35% risk weight. LTV 90%, between 80 and 90%, 50% risk weight. Now that facility has been enhanced for a further period of 1 year in order to mitigate the impact on the housing sector of any rising interest rate scenario, because of this particular on what we call ROC, risk adjusted return on capital, that would benefit the banks because there would be lesser deployment of capital for making available housing loans, and accordingly that particular extension of this risk weight, low risk weights, to continue till 31st March 2023 would mitigate to large extent the adverse impact of rising interest rate on housing sector. Now friends, these are the kind of rate sensitive sectors which are definitely, but what was generally happening in the economy? I mean, all our 8 core industries, refinery products, electricity, steel, coal, crude oil, natural gas, cement, fertilizers, they were all, doing reasonably well, and they were slightly above pre-pandemic levels. Things were going very, if we go back prior to February 24th, that particular event has put a lot of downside pressures. Now, one is very significant, which Sundarajan sir mentioned, is the supply chain disruptions. Now, this supply chain disruption, one is solely related to what has been said in monetary policy. That is only on the interest rate sensitive sectors. One is related to the change in the environment. Now, that is going to have very, very serious impact on so many sectors. That change in the environment, because of the crude prices going on, because of the kind of adverse impact, exports are going to have. He has talked about, wheat, barley, what level of exports were taking place from Ukraine, Russia. Now that is going to be impacted. That is going, edible oils, how much we were, like soya bean, sunflower, we were importing, all right? But with this level of disruption that has taken place, he was talking about what is the kind of, palladium, nickel, aluminum that is being produced by Russia. And that is very important for chips, semiconductors and all that. But when there will be that kind of supply chain disruptions, then the adverse impact on various sectors is going to be quite significant. Now, Rabi output may be very robust, but still, can you say simply because our Rabi output is going to be, this will have no impact on the agriculture sector? RBI is saying that because of these global developments, there is going to be an adverse impact both on agriculture, on industry, as also on services sector. That is the statement that has been made in the monetary policy statement itself. So all sectors are going to be impacted, not as a result of the monetary policy pronouncement per se, but because of the global environment which has unfolded since 24th February because of the outbreak. Financial service sector, there has been disruption. There were already certain supply chain disruptions. But now that has gone up. And the environment, he mentioned about domestic pump prices. You would have seen how many price increases have taken place. Are they going to come to an end? My own take is no. And there is going to be a second round price pressures, which is very, very significant statement. And you will see when it reaches, that is why they are saying the impact in input cost pressure when they are percolated down to the retail sector, that has to be monitored very carefully. That is what RBI said. Why? Because then it is going to spiral into it. All crude oil, petroleum products always have a cascading effect, you know, on all sectors. And that is the reason. It may not be an outcome of the policy pronouncement per se, but it is definitely many sectors are going to be impacted because of the changed global environment, which we have to keep in mind. And only impact that is going to happen is to be on interest rate sensitive sector, so far as monetary policy pronouncement per se are concerned. But I mean, though Dr. Dubey Saab would be talking about, bank impacts on banks, I just want to make one particular point. That is about one particular announcement. You know, in this kind of environment, what happened on the announcement day? Though equity market went up, bond prices, just jumped. And now there is an expectation that 10-year, benchmark security may go up to 7.4%. It has already breached 7.12% on that day. And they know what is the kind of government borrowing program that has been already announced. And what RBI is doing is proactively mitigating some of the foreseeable risks that is likely to happen. Now they knew that borrowing would become difficult because bond prices have started going up. And when bond prices go up, when bond prices, this yields go up, what is the impact? Interest burden for the fresh borrowings would also go up for the government of India. What they did? Okay, in order to ensure that everything is not mark to market, they have increased the SLR holdings in HTM, which was earlier increased from 19.5% to 22%, up to 31st March 22. Now they have extended it up to 31st March 2023 and increased it from 22% to 23%. So what I am saying is, while there are risks emerging on the context of various sectors, RBI also proactively making or announcing certain measures in order to mitigate those risks. And let's believe with the kind of proactiveness which RBI has shown during the pandemic period, the kind of liquidity measures of around 17.2 lakh crore that were announced, which are now being gradually wound up. RBI will continue to take appropriate measures in order to ensure that growth impulses taking place in the economy are not adversely impacted to the extent possible. But always remember, there is an external environment which impacts all sectors of domestic economy. And currently, we are going through that particular phase. Thank you so much. I will now request Dr. Dubey to share with you his thoughts.
Thank you, Kaleji. Namaskar. Good morning. Happy Ram Navami to my dear friends, everyone here. Respected Shri Sundarajan ji, Tangsale ji, Farid Bhai, Arvind Mohan ji, and all dear participants. And greetings and congratulations to all those, whether present here or not, who got promoted to next level, taking our support from webinars of Elite Banker Club or otherwise. Well, friends, coming in the last have both advantages and disadvantages. All my senior friends, all my colleagues have already covered, I think, almost all the points. I can't say most of the points. There might be some repetition, but I'll try to be brief because everything has been covered. Would confine myself to impact on banks, right? You are all bankers here. So the summary bullet points I may throw just now. Consumer confidence has been found to be improving. Growth target revised downward. Inflation raised upward. What is the impact of these 2-3 things? My all friends have already explained. Look, repo rate remained unchanged. So all bank loans linked to repo rate will not be affected. Deposit rates to firm up. Well, this is what is going to be an outcome. Some banks have already been, doing this in bits and pieces, but this may happen now more pronounced as the time moves faster, as also hint for pressure on credit and advances rate to go up sooner than later. Maybe I feel in the next policy that maybe down the line in June or somewhere in between, rates will start, credit rates will also firm up. So this one big impact. Right now, bank rate remained linked loans not to be changed, but deposit rates start increasing slowly. Maybe after some time, credit rates also catch up. Yes, SDF has been introduced, though inflation fears continue because of the global war and other situations. But RBI governor has announced sufficient liquidity. Yes, some change instead of reverse repo being changed. SDF has been introduced, that is overnight rates to go up very soon, maybe in a week's time. Housing, a good benefit for housing loan beneficiaries to continue to benefit as lower risk weights, they're going to be there for one more year up to March 23. This is something I think everyone was expecting. So this is on the expected lines, and this will release more capital to firms to extend credit further. Yields surge on high inflation goal revision and lower growth plan. Now, yield surge, it will have its own impact, explained very well by my three colleagues. Big NBFCs, big NBFCs, which are big NBFCs, top 5-6 NBFCs, to decide their own future. Unlike, HDFC has been merged with HDFC Bank. There may be more, there may not be more, but RBI would not nudge any NBFC to become bank. Governor has said that very day that they have to decide their own future irrespective of HDFC merger with HDFC Bank. Yes, a new thing is happening, which will be a safety for ATM card holders, debit card holders, cardless cash payment withdrawal from ATMs, which was till now available from some banks sporadically, is going to be there by all the banks using UPI. So practically no card required. Raise HTM limit, creating more headroom to buy more government securities with making investment depreciation without making any investment, depreciation provision. These are the major impact on the banks. There may be some, things here and there. I think I was going to explain impact of SDF, but perhaps it has been already covered that this and marginal standing facility MSF will be the floor of the LAF corridor. HTM, I just think, I think, Mr. Farid also covered discussion paper on climate risk and sustainable finance. So I won't take it further. There is going to be a committee for review of customer service standard in RBI regulated entity. It is good move as long as service industry is there, as long as banks deal with public. Customer service is always going to be the focus, and always there are required more measures to improve the same. When ATM, new thing of ATM comes, or whenever there is a change in technology like digitalization happening a lot, RBI has come out with a separate digital policy. Government yesterday, MOS technology IT announced that they are going to have another, this policy, data privacy policy. Data secrecy, data privacy policy is also likely to come properly, as it has been with the Standing Committee of the Parliament for more than 2 years. So with these things coming up, digitalization, some banks, Union Bank announcing 1,000 crore investment in 1 year. Now with all these things happening, it is not that services improve overnight. Sometimes there is a disruption, because these will create a lot of disruption in the market. There will be some improvement. At some other level, there will be some disruption also. So service improvement and the safeguard for that, customer service standard to be maintained, it is a good thing. I welcome that. Bharat Bill Payment System, that is rationalization of net worth requirement, has been done for the operating units, bringing their equity down from 100 crores to 25 crores. This is also going to have good impact, bringing more players on that area. I think most of these things, this is likely to be the impact on the bank. Not, I find anything more than that. So this is what I had with me, the impact on banks or the major announcement made, and other things, and some of these things also very nicely covered by Sundarajan-ji, Kalia-ji, and Farid-ji. So some points I repeated which were related to this. Rest of these things I will leave it to our participants to raise questions if they have any, and all four of us will try to see that you are satisfied on that area also. Thank you very much. Over to Arvind Bhai.
Thank you, Dubey sir. And thank you, Sundarajan sir. Thank you, Farid sir. And thank you, Kalia sir, for having given us a very descriptive and very, I would say, clear understanding of what the monetary policy has been about. And now, before I start the discussion in which our other senior mentors will also be participating, I just had to make an announcement. As all of us, we have congratulated the people who have succeeded in this promotion process. Many of our club members have succeeded. Our congratulations to them. I understand there is a promotion process underway in Punjab and Sindh Bank. And for them, we are going to hold a common session tomorrow at 8 p.m. in which we'll be explaining the basics of interview process. Then all those who are registered with us, they will get a video of Dr. Farid in which the latest topics relating to banking for the year 2022 have been very nicely explained by him. And after that, we will have mock interviews with them so that they get fully prepared for their actual interviews. In that mock interview, our mentors will also give them the complete guideline as to how they have to study their application form, how they have to prepare, how they have to answer, and they will also be addressing their individual questions in that session. So those who want to register, some of the club members, they have already registered with us for that session. And those who want to register, I'll request them to register by tomorrow afternoon, because we are going to have this session tomorrow at 8 p.m. so that they can attend that session. So now I invite Tangsale sir, Sundarajan sir, Kalia sir, Dr. Dubey and Dr. Farid. Up till now, they were constrained by the boundaries which were laid down that you have to speak only up to this. Now they can give their overview of the policy and give their observations also. So over to the panel now.
So let
Thanks,
me at
Alex.
the outset compliment Sundarajan ji, Farid Saab, Kalia ji, Dubey ji, an excellent presentation and the way you have explained as a practical banker. I think reading any economist, you find it difficult to really understand and decipher. So it's very simplistic, a practical banker view. I must compliment for it. But 2-3 things which bug my mind all the time when we talk of the monetary policy is that we always say that credit to GDP ratio of India is much low as compared to any developing or developed countries. Our credit to GDP ratio is barely 55 to 60%. And various developing and developed countries have got more than 100%. That clearly shows that there is a sufficient gap where we can grow. And I think this growth can be probably seen in every sector, right from agriculture to the infrastructure. But unfortunately, I don't see a direct direction on these issues, one. And secondly, I'm sure Sundarajan sir and all of you will agree, we have seen the time when there was a correlation between the GDP growth and the credit growth. The typical credit growth used to be 2 to 2.5 times of the GDP growth. If the GDP was 8%, the credit growth will be anywhere between 15 to 20. Yeah. So now this kind of correlation is not at all visible and not even been talked about by the bankers when they give the views. So these 2 points I thought as a practical banker, which I've been probably talking while I was in the position of the IBA or this. So how do we address this issue that the alignment of the GDP and the credit growth is brought in back, and the credit to GDP ratio, every year there has to be a growth into that, and there should be some directions given on that. Sir. Sir, you're on mute, sir. Sir, you're on mute.
Actually, Mr. Mohan, you have brought out a valid point. See, what happens is when the engine that is running fast, it develops a slowdown, it requires an additional push, then only it will be able to run in the same way, because F is equal to ma, and like in Newton's first law, F is equal to force, mass into acceleration. Now, bankers are used to the concept of, because of the COVID, I would not blame them, that narrow banking has come. There are a lot of complaints from Msme saying that even they are not applying the thing that no turnover ratios, my limits are less. Banks are saying that no, we are comfortable lending to Msme at the same level. Don't look out for any increase in the limits. That way, a lot of complaints are coming from this. I'm not saying it is a blame because I'm out of the system. I'm saying so. It is a high time. All along, the business optimism level was also at a low level. Now it is improving, but unfortunately, again, the setback of the war has come. So I do not know how far there will be thing. Capacity utilization is also improving. This is a time where the banker should encash on that opportunity and then start doing it. Again, the fear of the NPA in the large advances are also made the bank management to move to the retail. Again, retail also, they say that no, retail is also having the flaws and it can be NPA even in the retail. Now, the corporates seem to be good thing. Now, like a risk capital, the ground rule has come, the risk capital, you take it from the bond market. For the normal facilities and other thing, you come to the bank. That way, if it is come, it is a thing. And thanks to the classes conducted by Mr. Kaliaji and others, banks are also aware of what are the protective steps that they are required to take it. We should compliment Aravinji for the bankers helpline, the classes, how they should go on monitoring these advances so that they will continue to be thing. And the fear of that now 3 C's and other things are also moved. High time. Now this is the time for the banks to push up the credit. It should go up. You are right. At least 2 times the GDP growth rate, there should be a reflected in the bank credit. It is not happening. Now, the problem is this monetary policy is very, very important. It has created a lot of concerns. Even the RBI governor will be spending a sleepless night. Now, the deposits, all along the deposits are coming now. How the deposits will come now? Because Food and Agriculture Organization has said that on your necessities, the food itself, your inflation is going to be at least 20% increase is going to be in the cost of the food. Now, people save the money for basically for 3 purposes. One is transaction purposes, another is the precaution purposes, third is the investment purposes, speculative. In economics, we call it as speculative. Now, if you see the financial stability report of the previous one, not in January, the previous one, July, it clearly says banks' CASA have gone up, but deposits have not gone up to that extent. So people now are uncertain about the future. They don't want to block the money in the fixed deposit. They want to keep the money in the current and savings only. So the banks are going to find a problem because as a branch manager, when I come to a branch, I will take a 3 years deposit. So my term, it is ensured that my deposit will be there. But that is not going to happen now. This is also going to be a challenge, which is this monetary policy is also going to create a thing. I would expect the CASA to go up, not the fixed deposits to go up. So that is going to be another worry in the minds of the banks that is going to happen. Yes, credit has to go up. Now the setup is there. I mean, these external factors in economics, we always use the thing ceteris paribus, other things remaining same, but other things will not remain same at all. One has to take a thing, calculated risk, and then he should lend. Definitely, there is a scope for bank credit to increase.
Thank you, sir.
May I also share my thoughts, Saleh Sahab?
Sure. Bilkul.
Sir, you raised 2 very pertinent issues. One is about why in our country we are having low credit to GDP ratio, and also as to why is it that credit growth is not putting up, which was directly, having a positive impact. Higher credit growth used to have a positive impact on the GDP growth of the company. These were 2 issues. I think first issue is, yes, as compared to various countries, our credit to GDP ratio is very low, 55-60%, as you mentioned. But you will also agree that credit to GDP ratio also depends upon the particular phase of economic development through which a particular country is going. There are advanced economies, there are emerging economies, and there are underdeveloped economies. Now we are still in the range of emerging economies. I mean, we are still not reached that level. There is a lot of push that was being given to the infrastructure development. At particular point when all of us used to be in our active service, and that was pushing credit growth significantly. And that was also contributing to, we remember those good old days when 8.5 to 9.5% used to be the GDP growth. And you were absolutely right. At that time, there was a correlationship we always used to have, that in order to have this level of GDP growth, credit growth has to be at this particular level. Unfortunately, a lot of developments have taken place since the AQR, asset quality review that took place. And because of huge emergence of NPAs, entire environment has undergone the kind of stress that was experienced in the infrastructure loans. the kind of change environment, as Sundarajan sir was mentioning. I mean, now large corporates, where is the impact? Is the impact on MSME lending? According to me, no. Growth is taking place in MSME, maybe because of this emergency credit line guarantee scheme, maybe because of other push that is given. There is a growth in agriculture. But what has been very seriously impacted is the large industry manufacturing. Why it has happened? Because large corporates now are accessing capital markets. Large corporates, even for their major requirements, are accessing debt markets, which was not the case earlier. Earlier, RBI has to come through the guidelines through which they were urging, no, you have to necessarily beyond this particular level, you have to go to the market to, meet your incremental requirements. Now that environment has undergone a change, and that we are seeing. That is why the credit growth is not taking place to that particular extent. And it is very rightly said, unless and until there is that kind of credit growth that takes place in the economy, GDP growth cannot reach the kind of levels that we want. So that is very obvious. But today, that credit growth is not that across all sectors there is no growth. It is primarily because of this, primarily because of the adverse impacts, and primarily because of the kind of environment that was created after asset quality review, when people started becoming more and more, earlier we used to be proactive in lending. That is not the scenario today. And scenario has undergone a change. There is a lot of development of capital markets, development of debt markets, dependence on the bank credit has come down, and there is a strong emergence of NBFC sector. Now, all these factors have to be taken into consideration while really finding out an answer to the kind of vast question that you have posed. Thank you, sir. I thought I will
Very
just mention.
I'm sure the participants will get a lot of inputs out of this discussion.
Actually, Mr. Mohan, I want to add one more thing. In India, we have a peculiar system, what is called the informal credit.
Yeah, that is.
There is an informal sector. See, formal sector 50% means informal sector 50%. Now, this informal sectors received a beating. Two beatings at the same time. One is demonetization.
Second is COVID.
Second is COVID plus this this one also this one from the VAT to be moved
GST.
to the GST.
Yeah,
That
GST.
also created a problem for that. It is not able to revive at all. And another thing, as rightly said by Kalia Saab, economies are different stages. What is the stage at which Indian economy is there? If you see the different stages, the first stage is called the primitive society. The second stage is called preconditions for takeoff. Third is called takeoff. Fourth is called drive to maturity. Final stage is called age of high mass consumption. This is what economists will always treat it. India has been for quite long, we are in the stage of preconditions for takeoff. Now we are bordering on the takeoff. Once you come to the takeoff, automatically the pickup and go very well, and then it will happen. Yeah, thank you.
I only want the participants to take the message that there is sufficient opportunity for growth,
Yes.
and they must look for this, because the third thing which I am again leaving it for Farid, and of course, when we talk of inflation, in our language, it is too much money chasing too few goods. Simple understanding of the inflation. It means the requirement of more production, more supply, and again the credit. So
unless it is
Faridji,
imported inflation, Saleh Saab, unless it is imported
Haji?
inflation, unless it is imported inflation.
No, but I think still, if you really look to it from a banker's view, I think we should look at the areas where we can support more and more production, not only as an import substitution I'm talking about, but I mean, where we can really see that the supplies could be increased, demand is getting more, and that's where the inflation can really be addressed a bit. That's all from my end. Thank you so much.
Farid sir, you have something to say on this?
No, just I thought Tangsaleji was referring my name. That's why I was.
No, I maybe you can throw light on production to address the
Yes, sir.
inflation.
Actually, production even see our country is majorly depending on agriculture-based country. Even our food grain production is very surplus, and we are in a position to export. The major problem of food inflation is being caused by the oil, edible oil, pulses, and oils, other things. So even after Green Revolution from 1966 to now, even though about so many 60 years is completing, second Green Revolution, third Green Revolution has come, we are depending on the mostly import of the edible oils. That is causing the major import bill. Not only the import bill, it is causing the food inflation to increase. So the crux of the problem is the government of India or the state governments should encourage the farmers for going for the diversification of crops from fruit grains to oil seeds and pulses. Even there is an increase in the area in respect of oil seeds, there is no substantial increase in the production, because even from the scientific community side, there are not good varieties have come for higher yield of the oil seed production. So now government is giving, sometimes they will give importance for oil palm. They will say that the mission for oil palm, some other time they will go some other crop, but it is not being done consistently over a period of time to replace the edible oil import. Second thing is, as you rightly said, sir, the credit to GDP ratio, no doubt it is about 56%. But if you see, even in spite of this pandemic and all, it has shown an incremental growth of only 5 to 6% in the credit, but it has improved from 52% to 57% almost, 5% during this period in 2021, which was mainly affected by the pandemic. Maybe the increase may be because of this emergency line of credit and all, maybe that one to the mainly for MSMEs, but it has not reached to the 64% which it has achieved 2015. That has achieved, as rightly told by the stage of the economy. At the time, the economy was expected to perform at 9%. So there were with a lot of investments by the promoters and all. So the credit to GDP, that overall GDP amount was also less at that time, but credit was more, so that ratio was more. Now the ratio has come down because GDP increased, but the credit growth is not happening. Even 4% GDP growth, credit growth incremental is 5%. It is not increasing that ratio. That too, corporate credit has come down drastically. This SME credit, retail and agriculture credit will not increase the credit to GDP ratio.
Correct.
No doubt, China among our BRIC countries, China is having 160% credit to GDP ratio, but that itself now I think causing a little concern for the China government also, having reached to 165%. That's my point.
Thank you.
Mr. Mohan,
Thank you.
Mr. Mohan, I just want to add,
Yes.
inflation, you said that no, too much of money facing too few goods. That's a normal definition. Whereas this time, if you see, it is not a demand side inflation, it is a supply side inflation.
That is what I was saying.
Because supply is not sufficient. Now, you see the malls in different states, malls are all empty. People have the propensity to consume. The propensity to consume has also come down because they don't want to consume. They want to keep it because of the uncertainty. That is also another thing. Unless the supply improves, this inflation will continue. Unfortunately, supply side bottlenecks continue. Okay, thank you. Thank you, Mr. Mohan.
Thank you.
Sorry,
Thank you.
Sir. Thank you.
Thank you. So I request if I could exit. Thank you.
Thank you, sir. Thank you.
Thank you. I've taken a lot of time of the participants, so let the
Thank you.
participants' question come now.
Right.
Any-
Thank you, sir.
And now I'll invite questions from the participants. Any questions they have, they can ask the panel members. No questions seem to be coming. So I take this as that there is no question as such. And I thank the panel members, Sundarajan sir, Dubey sir, Kalia sir, and Farid sir for having worked so much on study of this monetary policy, because the time was very short. It was announced on Friday and we had this session on Sunday. The time gap was very little, but within this small time also, they came out with such elaborate presentations so as to make things very clear to the participants. And I hope all the participants, they have benefited. I also thank all the participants for having attended this session, and I am sure all of them, they will find it useful. With that, I thank all present here and bring this session to an end. Namaskar.
Namaskar. Thank you. Thank you,
Thank you,
everyone. Thank you.
Thank you, sir. Good day.
Thank you. Thank you all.
Thank you.